All right, folks, we're talking about the plight of the little guy and gal. First, let's start on the business side. We know the NFIB report this week was shocking, in part because optimism, it's starting to edge down. And what really is worrisome is this is what they call hard data here. So you've got two components of that. You've got the hard data, then you've got soft data. The hard data is really coming down hard. That's not an opinion, folks. That's really hard data. I think nothing shocked us more than this, though. This line here, uncertainty has never been higher. So right now, we're talking about a stock market at all-time highs. Everyone keeps coming on the show and saying how great things are doing. Uncertainty for small businesses, never been higher than it is right now. And another source of their pain, and I'm talking really big-time pain, what they're paying on short-term loans has skyrocketed. See this number here? That's 10%. Look where it was down at 5%. So that number has doubled. And consequently, what it means is CapEx, the yellow line, what they get to invest in their own business, that has plummeted. So they're not even able to really build their business for the future. Then let's talk about just regular folks, right? Look at your credit card bill now. 23.4%. That is absolutely ouch territory. I want to bring in QI Research CEO, Chief Strategist, Danielle DiMartino booth. And Danielle, you've always talked about small businesses. And I just want to tell you why we love them. Not only are they the biggest job producer in our country, we love small businesses. Look at that. We love small businesses more than the police, than everything. Yep. And yet it feels like no one helps them. The politicians don't help them. Policies never seem to help them. Nobody helps them.
No, and now their lenders are kicking them when they're down. When you think about the differential between the prime rate, where the biggest companies can borrow from a bank, what that rate is, and where small businesses are borrowing, you just put 10.1% up there. That's more than a 2 percentage point difference between the big guys and the little guys and the little gals. It's huge, and they're being penalized for being the largest business creators in the country by having to pay up if they want to try and grow their businesses, which the other chart you just put up showed they can't grow their businesses.
Right. So then what happens here? I mean, it's
Look, Charles, nobody wants to talk about it. It's not polite conversation, but we're seeing small businesses continue to go out of business one after another after another. We're seeing a pickup in the bankruptcy cycle on the small business side.
I'm going to bring up U.S. bankruptcy filings in general right now, so we can see the level we're at. I mean, maybe we were a little bit higher in the COVID. Yep. But outside of that, you've got to go way back to 2010. Yep. And this is picking up. I mean, and what is this all about here, and how bad can it get?
So, you know, if we were to put up a next graph, so to speak, we would show that there's a cycle, right? When a company goes out of business, it's going to affect the company's employees next, and they're going to have a hard time making their bills. And what we're seeing is that a year ago, personal household bankruptcies were growing by 14% year over year. They were south of 20,000 at the time. Now that rate's growing at 22%, and it's north of 24,000 just in the month of September. Households applying for Chapter 7 bankruptcy protection.
So the business goes out, and a few months later, okay, well, that makes a lot of sense.
It cycles through.
So I'm looking at today's market, right? And you see these are the winners so far today. Norwegian Cruise Lines, Carnival Cruise Lines, Royal Caribbean, right? Caesars. It just
must be nice.
Yeah, it must be nice. Essentially, this gets back to what almost, I'd say 85% of my guests always say, that the consumer is spending. But it's not every consumer, right? These are just rich folks. So rich folks are doing pretty good.
That's exactly right. And those who have, and that's why we have what we call a K-shaped economy. But we have to bear in mind that student loan, the non-payment of student loans, you're actually going to get penalized for that after Halloween of this year. And so that's going to hit some of these spenders. And again,
because some of these folks on Carnival.
Right. And a lot of these people are spending on credit cards. And we're seeing that credit card loans as a percentage of bank loan books outside of mortgages, it's already hit 56%. So a lot of these people spending don't necessarily have the income to back it up.
But they're having some fun. That's what you call YOLO or something like that. So we get CPI tomorrow. Does it really even matter? I mean, at this point, the Fed has, after the jobs report, the Fed has been in an awkward position, right? Because they're getting a lot of pushback, certainly on another 50 basis point cut. But even cutting as much as they were going to cut before.
Yeah, and you saw that in the Fed minutes that came out today, that there was a very robust discussion between 25 and 50 basis points. And of course, the minutes are going to be made to sound more hawkish than maybe the meeting was at the time. But still bear in mind, Charles, more than 50% of the private sector jobs being created right now are in education and healthcare. Look, if you're going to get sick, you're going to the doctor. If you're going to go to school, you're going to go to school. The private sector job creation, though, is not what we need for it to be.
Right. I mean, and that is really, really remarkable because the way it's reported is somewhat disingenuous and dishonest. Even the revisions, what you brought to my attention last week, were down for the private sector.
For private sector, they were down.
Great stuff. See you soon.
Charles.